early stages, right? I would say, it's like much more simpler than, at later stages where you rely on a lot of data that's, getting validated by the companies. I would put it across, four pillars. One, and which has got the highest weightage, especially in this stage, founders. Do you think, these founders can pull off for this long journey? Are they built for resilience? Are they built for adaptability? Are they willing to listen to you? I mean, it's not like they have to listen to everything, but are they at least willing to take feedback? Listening is as important, or more important than, responding. I think that's something that I at least, look for in a team. Are there complementary skills between the team? And, it's always safer, to invest in teams which have at least two founders. The risk levels reduces for us, if there are at least two founders. More than two, up to three is fine. I think, more than three also kind of becomes a crowd. I think, 2 to 3 is like really optimal number of founders, that kind of works. So we do look, I'm not saying this does not mean that we will not look at solo founders. We will look, see, I think, sometimes solo founders have worked, you can see those large cases in the past, but it's better to look for at least having somebody with two founders. Those are founder qualities to look for. Of the four things that I mentioned, founders, that's the first one that we talked about now. The second thing, everybody is competing, right? Second thing that we look for is, let's call it innovation or disruption if you want, right? Or differentiation, whichever way you want to call it. We call it internally as disruption. Do you have a company which is doing something very different? I think, when I say different, doesn't mean that it has to be like completely out of the box or out of the whack, right? When I say differentiation can come in multiple factors, right? It could be product differentiation. It could be their go-to-market differentiation, or it could be their marketing that is very, very differentiated, right? So I think it's not just, it's a unique idea or it's a wacky idea that I'm talking of. I think disruption, happens sometimes even in the UI, UX play, could be a large differentiation which kind of accelerates someone. So I think there's multiple factors of disruption and differentiation to look for. Having at least, one, two of the differentiation in a product or a service is critical. That's something that we look for all the time. And that kind of, I mean, if we are going to fund one more exact copy of another company, right, I think it doesn't make sense, especially if it's the fourth or the fifth company, right, in the same space, which is doing an exact copy of what's happening. It doesn't make sense. I'm okay with even geography copies, because, you're addressing a new market, you need to understand the new face. That's fine for us. That's okay, because the market changes, a lot of dynamics changes. It's not necessary that, you bring an exact product, it works in India, what's probably working in US. So I think that's the key thing to look for. Have differentiation in the product or the team, and in any angle, at least look for a couple of angles in the differentiated in. The third thing to look for is market. See, I think fundamentally, right, if all of us understand angel investing, seed investing, or the venture investing in particular, right, I think most of you would have heard people talk about power law. What does it mean by power law, right? A very few number of companies will give you all the returns or the entire fund in some cases, right? So given that kind of a curve, right, every investment that you do, you are maximizing to get the complete return of the fund from that company. That means to say that at the time of making investment, that's what it means. So when you're evaluating, you evaluate from that lens, saying, okay, is this company going to return my entire fund or more than my complete fund? Okay, one single company. It's like asking, to more simply, can this be a 100 million company minimum, or can this be a $500 million value company? That's a question that you ask repeatedly every time you evaluate a company. That the reason for asking that question is because the market has to be big. That's the third pillar that we're talking of for evaluation. Market, if the market size is very small or is extremely competitive, right, it doesn't make sense to get in that space and try and create your own space. But having said that, right, you have to also be aware that sometimes a product which starts off a new, innovative, differentiated product, right, creates markets. So you need to carefully evaluate, is this Me Too product which is going after the same market, or this is a Me Too product from some other geography, but it's not available in this country, or is this a completely new product is out to create a new market? Sometimes it's market creation exercises, right? This happens because human beings, fundamentally evolve. Like classic situation is today, right? I mean, we have a COVID situation, so everybody and anybody is moving and trying to do grocery, right? Because that's the only thing allowed. So the market is dictating, what can be done by startups. In normal times, right? I think we don't see the sensitivity of reaction to what the market wants, because all of us assume what I want, what you want, or maybe what Nishchay wants is the market, and go after that. I think you need to think deeper, need to understand the market and understand, is the market ready for this? I think today the market is so sensitive for certain categories. That there is no demand for this today because it's so absolutely clear. In normal times, can you evaluate that and look at it and understand signals from the market to say, okay, this product can have a large market opportunity? Can you capture 100 million of revenue in like 5 years or in 7 years? Can the company that you're investing in capture that kind of value, right? I mean, any 20 million revenue company can be valued at like 100 million. I'm just saying, 100 million revenue company can be valued at like $1 billion easily in today's environment, right? So you have a unicorn if you have $100 million revenue opportunity company. Yeah. So the last thing, before I think I stop for some questions or for any other clarifications, just want to say the last thing to look for, given all of this, great founders, you found a differentiated product, and the market opportunity is large. Let's assume you have like a bunch of founders or a bunch of companies who are doing all this at a similar scale. The last thing to look for, is, as somebody got some traction. When I say traction, it means validation, customer validation. Have they shipped the product? Are they seeing any metrics? The more the metrics, right, the reduced risk for you. If there is more validation of the data, right, it's reduced risk for the investors. So if I have a choice where of the 4 pillars, the 3 pillars are same and traction is the only criteria that I have to decide, right, I will go with a company which potentially has a higher traction, assuming all other criteria are same. So I'm just saying, so keep that also in mind. Sometimes we get driven by traction alone or saying, are you ahead? But traction alone does not work, but traction plus good founders plus disruption plus market, all in conjunction works. I think the last thing that I want to highlight is timing. Everything in the universe is function of time. I think similarly, right, for startups also, right, it is categorically also a function of time, right? I have had personal experience where what is a feature on cred today was launched in 2014. I had invested. Obviously, the timing was completely bad. The company went to zero, right? I mean, the credit card penetration was so low at that time, and today, right, it's a feature on the cred. Cred, it is basically deals on your credit card is a feature on credit. It's a very small feature. That was a company at that time. So I think timing is absolutely critical of what what does the market need and where are you, and the last thing in the timing, right? Timing, you don't decide, I don't decide. The earth rotates, and that's how it decided. So there is that little bit of randomness and luck and serendipity that has to come your way and to all our ways, to make that company to be the chosen one, or for investor also to make the choice, and hopefully he also makes his money.